Opinions expressed herein are subject to change and not necessarily the opinion of the firm. Past performance is no guarantee of future results. The information presented herein is for informational purposes only and is not intended to provide personal investment advice. It is important that you consider your tolerance for risk and investment goals when making investment decisions. Investing in securities does involve risk and the potential of losing money. The material does not constitute research, investment advice, or trade recommendations.
And now introducing Mr. Keith Lanton.
Good morning. Here we are, November 9th, second Monday of November. So we're going to get started this morning. Going to talk about financial markets. Of course, a lot going on this morning. Futures up very strongly. Also going to talk about presidents. Over the weekend, we did get most of the, if not all of the press confirming President-elect Joe Biden as the next president. And speaking of presidents, going to talk a little bit about our first president, George Washington, and then going to talk about markets this morning. Going to turn it over to Brad to add some further insights. So this morning, before we get started, got some very positive news as hitting the wires this morning that Pfizer and BioNTech has reported that they have had a very effective result from their vaccine. BioNTech and Pfizer reporting that they have more than 90% effectiveness in their vaccine for those who had not previously had COVID-19, and that is certainly giving financial markets a lift, and we'll talk some more about that. On this day, 125 years ago, and it was just 125 years ago, a German physicist, Wilhelm Röntgen, became the first person to observe X-rays. Röntgen's discovery occurred accidentally, where he was testing cathode rays, and he noticed a glow coming out from the cathode rays on a nearby screen. He didn't know which rays were creating that glow, and that's why X-rays are called X-rays, because he called them X as unidentified. Subsequently, he discovered that these rays could penetrate flesh but not bone, and thus began the era of medicine being able to incorporate X-rays into diagnostics. So today we have potentially a really encouraging news for COVID-19 in the medical field, and 125 years ago, and it was just 125 years ago, the discovery of X-rays. Now, I mentioned the presidential election, and appears that we have a president-elect after several days of uncertainty, and wanted to go back to our first president and the founding of America, and just go over some interesting facts, food for thought, opportunity to reflect. We often look back on history and think of it as the path was clearly defined, that George Washington became the first president, and while it was a difficult time fraught with challenges, we often forget about the uncertainties and how the path could have veered in so many different directions from what ultimately did occur. And we often tend to create images of heroic figures without recognizing that all their characteristics, like all people, were not perfect. So speaking about our first president, George Washington, Washington did have a education level of grade school. He was educated up to the age 11. At that point, his father died, and he was unable to continue in his formal education, and it was something that was a source of embarrassment for George Washington for the rest of his life. At age 22, George Washington led a skirmish in what at the time was the onset of the French, Indian, and American War. And that skirmish that he was involved with, which occurred when Washington was just 22, occurred in western Pennsylvania. And in that skirmish, a French officer, junior officer, but nevertheless a French officer, was killed. The French said he was on a diplomatic mission. Washington was the commanding officer. It was never verified who shot the first shot in this dispute. But nevertheless, this conflict continued to snowball, and this conflict became what became known as the French and Indian War, and soon spread worldwide into what became the 7 Years' War. And Washington was the commanding officer at that battle that set that off, perhaps giving him the opportunity to learn British tactics, French tactics, wartime tactics, and ultimately carry that knowledge into the Revolutionary War to become the leader that he was and enable the Americans to defeat the British. But at the time, he was much blamed as reckless and incompetent, and learned lots of lessons as a result of that. Something that we often are not aware of in present-day history. Also interesting is that Washington, when the Continental Congress met, was not necessarily the favorite, despite his impressive military record, to lead the Continental Army. The person that was seeking that command was someone with less military experience, but was the wealthiest person in the colonies, and that was John Hancock. And John Hancock, many may or may not know, made the bulk of his money illegally by smuggling. And as a result of the French and Indian War that we just spoke about, how Washington helped ignite that war, as a result of the French and Indian War, the British were cracking down very heavily in the late 1760s on smuggling. And this was significantly hurting the business of Mr. Hancock. And as a result, it's perhaps no wonder that he was a big financier in the Revolutionary War and was very active in participating in the Continental Congress. What's also interesting is in the late 1760s, when the British were significantly cracking down right before the Boston Tea Party, John Hancock was charged with smuggling. And although most accounts suggest he was guilty, his attorney was able to get him relieved of all charges, and his attorney was none other than John Adams. Speaking about George Washington, just returning to him for a moment, may wonder why I haven't heard a lot about George Washington's children, and that's because he had no biological children. He was a father figure to his wife, who he met after her husband died, Martha, who had 2 children, and both of her children died at fairly young ages, at 17 and 26. So Washington never able to have next generation for his family. Moving on to the markets this morning. Talking this morning about futures. We are seeing Dow futures up about 1,500 points right now. S&P futures are up about 150 points. NASDAQ futures were actually negative earlier, now have turned positive, up 65 points. So the Dow futures are looking up 5.5%, the S&P up 4.3%, and the NASDAQ up 0.5%, as at least this morning, rotation going on as a result of expectations that perhaps the industrial economy will reopen, and perhaps we will see a rotation in terms of investments. Also significantly benefiting from this is oil, which is up $3.76. That's for Brent, trading above $40 a barrel, up 10% this morning. The catalyst for this is news from Pfizer. Their CEO, Albert Bourla, was on CNBC this morning saying that the vaccine is 90% effective with no safety issues. He said he thinks there is a light at the end of the tunnel regarding COVID-19 following these results. The vaccine study should be completed by the end of this month. There are some side effects after the second shot, he said. He said that Pfizer and their partner, the German company BioNTech, he said they have 50 million doses available that will be ready by the end of this year, and 1.3 billion doses available in 2021. Important to note that 2 doses are required for each person. Rollout will be gradual in the first quarter of next year, he said, and ramp up in the second half of 2021. He called this the most significant medical advance in the past 100 years, and he said the election was not a consideration regarding the timeline. This morning, I mentioned the move in the Treasury market. Selling in treasuries, particularly longer dated maturities, has sent yields noticeably higher in a curve steepening trade. That should disproportionately benefit financial stocks. 2-year yield is up 2 basis points, but the 10-year yield is up 11, and the 30-year is up about 19 basis points. The dollar, which has been slipping, is up 0.1% this morning. As previously mentioned about President-elect Biden, futures were up 400 to 500 points prior to this announcement on the markets reacting positively to news that Joe Biden will be the 46th president, eliminating any election uncertainty and providing hope that Mr. Biden will advocate for less restrictive trade policy. So prior to the vaccine announcement, we were seeing those futures up about 500. We were seeing strength in Asia, in particular China, and we were seeing modest strength in Europe as well. Obviously, with news of the vaccine, that strength has gotten even stronger. Right now, the market is taking the vaccine news in stride and at face value, since it bodes well for the earnings prospects of many cyclical companies. There is some talk, though, that a vaccine this early might convince Congress to hold off on stimulus or pass a smaller stimulus deal. Right now, markets are in a euphoric state and perhaps not factoring in subsequent developments. Of course, we'll see as the course of events unfolds. In corporate news, Pfizer stock benefiting up 4.5 points to about 41, 12.5% higher. BioNTech is trading up about 20 points to about $112 a share. That's about 21% higher. McDonald's in the news. It's up about 5% or 11 points after earnings per share estimates were beaten, and they raised its dividend 3%. Companies that were seen as COVID-19 strong beneficiaries, like Zoom Video, ZM, down 15% as concerns that positive vaccine news may undercut some of the benefits that the stock was able to harbor as a result of people not traveling as they did prior to COVID. I mentioned the Asian markets. We see the Japanese market up 2%, the Hang Seng up 1.2%, the Shanghai up 2%, India up 1.7%, Australia up 1.9%. Greater strength in Europe. Europeans obviously under a lot more duress from COVID. Big wave going through Europe. So news vaccine viewed extremely positively. European markets up about 5%. France up 6.6%. Spain up 8.2% in Europe. There were some reports that the EU might hold off on imposing $4 billion on tariffs on U.S. goods to improve trade relations with the Biden administration, but those hopes were dashed as news reports came out a few minutes ago that the EU is going forward with imposing $4 billion on tariffs. This is in retaliation for some of the benefits that Boeing allegedly received improperly from the U.S. government. The UK said it is entering a crucial week for Brexit negotiations with the EU. Still lots of differences of opinion with respect to a whole host of issues. In the cannabis space, Canopy Growth, symbol Charlie Golf Charlie, beat by 28 cents Canadian cents, and they also beat on revenues. Reports this morning from NBC News saying that Senate Democrats feel that Senate Majority Leader McConnell may have little incentive to cooperate with their agenda, and they fear that he could block some candidates that Mr. Biden may seek to join his cabinet. Top Republicans still not acknowledging President-elect Biden's victory, as President Trump has said he will not concede, according to the New York Times. Washington Post is reporting that President-elect Joe Biden is planning executive orders to rejoin the Paris Climate Accord and the World Health Organization. Despite the positive news on the vaccine this morning, U.S. COVID cases hit a record high over the weekend, and we are seeing data move in an unfavorable direction pretty much across the board with respect to COVID cases here in the United States as we start to begin the winter season, although at least by weather here in the Northeast over the weekend, which was glorious, getting some relief from cold weather and hopefully from COVID infection in the near term. Biogen, symbol BIIB, has been in the news. They have a Alzheimer's drug that they released what was perceived as some positive data last week, and the stock soared. Then on Friday, there was some further data released, and that undid lots of the positive that was reported. Now the effects or benefits of the drug for the treatment of Alzheimer's being called into question. The stock selling off significantly this morning, so quite a wild ride for Biogen shareholders. Hopefully the drug is effective, because there really are no good treatments for Alzheimer's. So any good news there would certainly be good for humanity. Berkshire Hathaway came out with results over the weekend, saying that their businesses have been affected by COVID. The investment earnings were up significantly due to $24.8 billion of gains from investments such as Apple, whose stock rose 27% in the quarter. It represents 46% of Berkshire's portfolio. Berkshire owns $111.7 billion worth of Apple stock, so Berkshire inextricably tied to Apple's performance over there. Alphabet in the news, saying they will not file a motion to dismiss the U.S. government's lawsuit against the company, but said they will fight it in federal court. Navistar being bought out by Germany's Volkswagen truck unit. They already owned about 17%, and they are buying the rest of Navistar, symbol NAV. And Twitter confirming that U.S. President Donald Trump will be subject to the same Twitter rules as any other user when President-elect Biden takes office on January 20th. They acknowledge they give different set of rules to world leaders, and since President Trump will no longer be the current serving president, the same rules that apply to others will now apply to him. Looking forward to what we got going on this week. The earnings reports continue. Today we do have earnings from Zoom. We have earnings from SoftBank, from Simon Property Group. Tomorrow, the Supreme Court begins to hear arguments in a case challenging the constitutionality of the Affordable Care Act. This got lots of attention when the confirmation hearings for Amy Coney Barrett were being heard. Tomorrow we also get earnings from Lyft and Adidas. We have on Wednesday, Veterans Day, bond markets closed. Also Wednesday, 11/11, Alibaba holding its 24-hour Singles Day shopping extravaganza. A big jump in sales is expected. Thursday, we get the CPI, Consumer Price Index. Expectations are for 1.3% year-over-year rise. Core is expected rising 1.7% year-over-year. Thursday, earnings from Disney, Siemens, Applied Materials, and Cisco. Friday, we get the University of Michigan Consumer Sentiment. We also get producer prices, which are expected to show a monthly gain of 0.2%. So moving on to Barron's and the market. Barron's talked about market's reaction to the seeming election before it was confirmed of Joe Biden, and you know, there was one quote in Barron's here from they were quoting the philosopher Soren Kierkegaard on how we can evaluate how the market reacted to the election, and this is something I think this quote applies very well. Something that we often do when we're analyzing financial markets. Life can only be understood backwards, but it must be lived forwards. And after the election results that ran mostly counter to prevailing expectations, major stock averages enjoyed their best week since April. Markets saw their strongest gains after a presidential election since the election of President Roosevelt in 1932. By all accounts, if you knew the news before it happened, you probably would have agreed with what the experts would have said. It would have been a terrible week for the stock market, based on the data that came out before you actually saw what happened to the markets. At the close of trading on Friday, we still didn't know whether Joe Biden or Donald Trump had won. We still didn't know which party would control the Senate. There were at least 2 recounts, one in Georgia and one in Michigan, with more likely to come. That's the kind of uncertainty the market is supposed to hate. but instead stocks embraced the unknown. The Dow gained 6.9% or 1,800 points. NASDAQ was up 9%. The S&P rose 7.3%. The volatility index fell 35%. That's the largest drop since when President Trump was elected, and the fourth largest decline on record. The fear index, in essence, showing no fear. The consensus quickly coalesced around the idea that a divided government would be good for stocks without Democratic control of the Senate, which is now not a certainty, something that may not be determined until January if both of Georgia's Senate races go to a runoff, which now seems likely. The expectation would be that there would be no tax hikes, no Green Deal. Changes would be made, but they would be made around the margins. The economy might be a better explanation for the market's surprising strength. Every week we hear the pandemic is about to make the markets head south, and every week the data has been holding up better than expected. Last week we got the Institute for Supply Management saying the index rose to 59.3. That's the highest since 2018. New orders, the most forward-looking component, jumped to its highest level in 17 years. Last week we got payroll reports, better than expected, 683,000 new jobs added, unemployment rate falling to 6.9%. Some people might say and look back and say, well, I certainly wouldn't have expected this back in 2000 when we had a contested election between Al Gore and George W. Bush. Markets fell dramatically, but again, with the hindsight looking back, one big difference between then and now was if you look back at 2000, we had a Fed that was raising interest rates, we had an economy that was about to enter recession, and here we sit in 2020 with extremely low interest rates and data showing that the economy is improving. Perhaps another factor propelling markets, and maybe perhaps influenced now by this positive news about the vaccine, but the divided government may push the Fed to go bigger, Barron's saying, and here's what that may look like. Basically, the thought process is that if Congress and the President are unable to deliver on a fiscal package, perhaps the Fed's going to have to get more aggressive in terms of what they can do with monetary policy. Just last month, Federal Reserve Chairman Powell warned that too little support would lead to a weak economy, creating unnecessary hardship for households and businesses. He reiterated on Thursday of last week in a post-meeting press conference to the Fed meeting that risks to the economy, quote, would be well addressed through more fiscal policy. But if gridlock prevents that, the Fed is obligated to do what it can to promote, quote, maximum employment, stable prices, and moderate long-term interest rates. So what's the central bank to do with rates already at or near zero? Well, they could certainly push out the date of the first interest rate hike further into the future. But some speculating that that alone will not be enough to assist in the recovery without fiscal policy. So there are other options that a Fed may be able to exercise. In the CARES Act, the Fed was given $454 billion of funds to support trillions of dollars of cheap loans for hard-hit businesses, nonprofits, and state and local governments. As of last week, out of that $454 billion, just $16.5 billion had been used, mostly to support the corporate bond market, the asset-backed securities market, and about $5 billion to assist the municipal market. The problem here is that the terms of the program have been relatively unattractive. The rates that these entities could borrow from the Fed at are deemed to be higher than what they could get within the marketplace, even paying up somewhat for their weakened credit position. So therefore, these sources of assistance have largely gone untapped. And the speculation is that some of the reason for the Fed not unleashing greater stimulus in this fashion is because the Treasury Department, which has the ultimate authority over the Fed's facilities, has expressed reluctance to lose money, even though Congress appropriated the $500 billion to cover the losses on those loans that the Fed could make. So perhaps in a Biden administration with a different Treasury Secretary and a different staff, the pressure to avoid those losses and encourage the Fed to be more creative of working within the law to to get more money out to struggling businesses may be a avenue that the Fed pursues in a Biden administration. Moving on to a couple of other thoughts, and then I'm going to turn things over to Brad. I'm going to just mention one stock this morning, and that stock is Danone, which is a French company, probably best known for what we in the U.S. call Dannon yogurt. The symbol is DANOY. The company has been diversifying away from their slow-growth dairy business and recently announced a strategic review of their brands and are shaking up management, which some are suggesting could be the turning point for this stock, which has been a significant laggard. Many consumer goods companies have been good performers in the pandemic, but Danone has not. We have some analysts with some optimistic price forecast expecting this shakeup. Wells Fargo with a price target about 50% higher than the current target. RBC with a price target about 25% higher, and Bernstein with a more muted price target of about 10% higher. Danone has a market value of about 30 billion euros, trades at about 13 times this year's expected earnings, and has a dividend yield a little bit north of 4%. Finally, end with this thought, and then I'll turn things over to Brad. Interesting article in Barron's talking about tech stocks, which now NASDAQ futures, by the way, are up about 136 points. Dow futures are up about 1,750 points, just to give you an update. Barron's suggesting that the new favorite safe haven is tech stocks. We woke up Wednesday with the country in purgatory, occupant of the White House for the next 4 years unknown. And what did investors do? Well, they went out and they snapped up tech stocks, not gold stocks, not consumer goods stocks, but tech stocks. And Barron's saying that perhaps is a somewhat logical conclusion, given the low interest rate environment. And when you compare the valuation of tech stocks to some of those quote-unquote seemingly safer sectors, that tech looks increasingly attractive. NASDAQ 100, which makes up most of those big tech stocks, trades at about 29 times earnings, and the S&P trades at about 21 times earnings. The valuation means less when interest rates are low and investors are otherwise starved for growth. The NASDAQ 100 is expected to grow earnings 16%, while the S&P 500, at least prior to today, was expected to struggle to basically maintain their current level of earnings or have zero earnings growth. So tech has become all things to all investors. You don't need to buy small caps and startups when Microsoft is growing earnings 20%. Who needs consumer staples when Facebook is used by 1.8 billion people every day? Jim Paulson saying the bottom line is that tech has both been a bull and bear market play. Technology, to a large degree, is the new defensive sector. It has tentacles that extend well beyond the election outcome and the current COVID-19 pandemic. Netflix was already replacing television before COVID-19. Now it's replacing movie theaters. Zoom calls were already replacing business meetings. Now they're replacing business travel. Uber Eats was already replacing home-cooked meals, and now it's replacing restaurants. And the list goes on. What's also interesting is if you go back to 2000, the dot-com era, technology made up 35% of the S&P's value, but 7% of GDP, a 28% differential. Today, technology stocks comprise 17% of GDP and make up 27% of the S&P 500's market value. So instead of a 28% differential, it is a 10% differential. If you compare tech to consumer staple, the traditional place to hide out, consumer staple has done its job in the pandemic in terms of protecting wealth. The consumer staple sector is up 3% year to date. IT sector is up 32%. But staples aren't cheap either. You have to ask yourself, would you rather buy Google parent Alphabet at 29 times earnings or Procter & Gamble at 25 times earnings? So with that thought, I'm going to pass it on to Brad to talk some more about markets this morning. Good morning, Brad.
Morning, Keith. Thanks. Good morning, everyone. Last week, I discussed how treasuries had broke course with all other markets, and they weren't trading as historically you would expect them to. The stock market had a major correction in the middle of a couple weeks ago, and the treasuries also corrected meaning higher rates and lower prices, which is a very unusual movement that a lot of people didn't really understand. This morning, the Treasury market is behaving the way that we expect it to behave, and this leads me to believe that we are slowly getting into some beginning phase of normalcy in the markets, and hopefully, more importantly, in the world. There are lots of positive news for the market this morning. A vaccine is on the real horizon now, and it's politically looking like we're going to have a real balance of power between Democrats and Republicans through the three houses, which means that there will be no extreme moves with respect to the markets, and that means economically extreme moves. So for market participants, nothing to do with political feelings, the market should be relatively stable because of that. Back to my specialty, municipals. Municipals are still the cheapest spread product out there for anyone who's looked for fixed income in a taxable account. You can still find AA or AAA 30-year bonds with 10-year calls at better than 2.25% to the 10-year call and better than 2.6% to maturity. These spreads are still historically gigantic, even though the rates of return seem lousy. But you have to put it all in perspective. The 10-year Treasury is at 90 basis points, so you're looking at 2.25 versus 90 basis points. And the 30-year Treasury, even with this big sell-off this morning, is still only at 1.7%. So you're looking at 2.6% tax-free versus that. With the vaccine on the horizon, you're seeing the old world equities rally, and that's also positive news for municipals. Municipalities need their tax revenues desperately, and as life gets back to normal, those revenues will help stabilize the finance of communities. In the interim, municipals that have faced tremendous headaches because of COVID, such as New Jersey, which was just the latest casualty of a downgrade, were able to participate in the market through the Fed's municipal facility, the Fed's municipal facility buying program, which Keith had alluded to earlier, and that municipal facility program should be able to hold the gap until businesses are really up and running and generating tax revenues. The cities and states are absolutely still going to need stimulus to help all the COVID-related losses, and I'm more bullish on that happening now with the new president in, even with the Republican Senate. But the compromise, in my opinion, is going to be that bailouts will be for COVID-related economic turmoil and not for previous mismanagement of finances. So you have to keep an eye on Illinois, Puerto Rico, possibly even New Jersey, that had been mismanaged before the pandemic, that had bloated pension fund issues, and so keep an eye for that also. As I see the stay-at-home stocks getting really hurt today, that sentiment is going to bode well for municipals. It means people are going to, get out of the house and start spending money outside. I hope, regardless of what happens with the markets, there's much more to life, and hopefully we get back to normal soon. We get to see our families and friends. We get to go out for dinner, and in a normal world, the thing we'll be looking at, hopefully sooner than later, is how municipals are trading versus treasuries. And you'll have the one-offs of financial problems for certain municipalities. But generally speaking, I can't wait to get back to those days where you're looking at the treasury market, and the trends of the treasury market determine the trend of where the municipals are going. And I hope everyone has a great week. Thanks.
That's everything I've got.
Thank you for listening to Mr. Keith Lanton.